episode is brought to you by WHU, the Otto Beisheim School of Management. WHU is reshaping the way students learn about business, management, finance, and entrepreneurship through its innovative programs and partnerships in Germany and across the globe. To learn more about this globally ranked university, visit whu.edu today.
Hey folks, Gerrit here. In today's episode, we introduce Tim Thabe, co-founder and CEO of Germany's first publicly traded fintech company, Creditshelf. His journey is an interesting one, from doctoral studies in Mannheim to a successful career in banking, to the Kellogg-WHU MBA program, to, as of 2014, startup founder. We'll be discussing Germany's SME sector, P2P lending, why one might consider an IPO over equity capital, and much, much more. Hope you enjoy this episode.
Coming to you from WHU on the banks of the Rhine River in beautiful Vallendar, Germany. This is the best and most awesome founder podcast. A show about entrepreneurs, innovators, advisors, and educators, and the stories that make them who they are today.
So my name is Tim Thabe. I'm co-founder and CEO of Creditshelf, the marketplace lending business. So we connect German SME borrowers that need capital and institutional investors that are looking for investment opportunities in Germany. We run a digital business, so it's platform-based. We do everything from acquiring borrowers, analyzing opportunities, selecting the business that we want to fund, and then we continue the servicing all the way through the life cycle until the repayment.
So Tim, thank you so much for having me in your lovely offices here in Frankfurt. It's really great to meet you and learn a little bit more about the business. It's particularly interesting to meet with entrepreneurs that have come out of the incredible WHU entrepreneurial ecosystem. We can thank our friend Sven Greulich for bringing us together. I know you guys were in the same class. But I'm really interested to learning a little bit about you and kind of how you got to where you are. But maybe you can start with telling us a little bit about Creditshelf and just give us the 10,000 foot view of what Creditshelf does and how it can serve their customers.
Sure. So the 10,000 foot view of Creditshelf is that we connect two sides that have a complementary need. On the one side, we have SME borrowers in Germany that are looking for additional capital in the sense of debt. For various reasons, they've been underserved by banks in the last couple of years, and it continues that way. I mean, regulatory requirements, all kinds of things are happening. So there's an increasing gap on the funding side for SME borrowers in Germany. And on the other side, you have institutional investors that have they can invest in many things, but not into SME companies because they're difficult to find. Right? You can't just go and put debt into SMEs just by lending to them, because there's a regulatory requirement that you need a banking license, and it's very difficult to find these opportunities. So what we do is we find both sides, and we have a platform that analyzes, sources these opportunities and makes them investable, and thereby we bring two sides together that actually have a common interest, which is to move capital from A to B, and it's a transaction cost problem that we're solving through a digital platform.
So these SMEs, they're the backbone of the German economy. I think the German economy is notable for the strong medium-sized enterprises that exist here. What makes you different from a bank as a lender?
So from a structural perspective, we are not taking these loans on balance sheet, and we don't have our own banking license. We're using a setup with a banking partner that helps us fulfill our regulatory requirements. I think the basic difference is we are running a completely digital business, so we don't have branches. We don't take the loans on balance sheet, but what we do is we facilitate the transaction between the two sides, as I mentioned before. So I think the most noticeable difference for a client is speed. Right? We are able to do it much faster. We have a view in we promise 48 hours. Mostly it's even quicker, and we can, depending on availability of data, we can have a loan fulfilled from first request until payout in a week, whereas for banks it probably takes months.
So if you're able to do it so quickly, is this something that's driven by an algorithm, or is it a human interaction that determines the applicability and availability of funds for that business?
I think the secret is it's both. right? It's not a purely digital process, but it's also not a purely manual process. And the way we look at it is we employ expert credit analysts that have their expertise and experience and their judgment, but we want them to use their brains and not their fingers. What it means is, when we get 100 requests, not all of them will be able to get a loan. More or less, probably 10% will. And sorting through the 100 applications is obviously something that you can automate, right? So once you've got a first filter and you know what you're looking for, and you have I've used technology and data to kind of sort through the first batch, you can then use human brain to make a final decision, and then the combination of the two makes it much more efficient.
So this is such a big market that you're targeting. I mean, just in Germany or in DACH alone, I imagine this is hundreds of billions of euros worth of a size market. I'm interested in that kind of first filter. Do you have a specific segment of that market that you target, or like criteria that determine what range these businesses fall into that you're willing to accept?
Yeah, sure. So if you go top down, the German SME loan market is probably 300 billion euros, Germany alone. And currently, probably the latest data I've seen is maybe 2% of that is digital, in the sense that 98% of these loans are granted by banks through manual processes, meaning you walk into a branch, you talk to your bank manager, you get a loan. But that 2% was less than 1% probably a year ago or 2 years ago. So basically the market's huge. We believe the opportunity is huge because the digitalization of SME or professional banking is going to happen. We very strongly believe it will. There is a lot of precedent that you can look to. For example, in the consumer segment, we're only lending to SME corporates, but the consumer loan market is smaller than the SME loan market, but it's already 15% digital. So, and that used to be low single digits probably 5 years ago. So the digitalization of that lending market has already happened and is starting to accelerate. And I think this is where we are right now with the SME market, where we see it accelerating. And we strongly believe that the digital penetration rates in SME lending will be similar to consumer lending, even though a few years, if you will, lagging, which is a normal development because most things happen first on the consumer side and then move into the B2B side.
Assuming that you're kind of a leader in the German space, are you seeing more competition arising? Are you getting competition from outside of Germany, or are you really a lone player in this space right now?
Well, you're never fully alone. I would say we were very early because we started in 2014. There's a few competing platforms, and there's a slight differentiation between models. So we are actually, as I said, we are arranging these loans front to back. There's some comparison sites that basically attract requests and then channel them to banks. It's a slightly different model, although from the customer front side it looks similar. These are also growing strongly, and I think what we've also seen is some banks are starting to catch up as well. There was one competing platform that was actually bought by ING, and ING is now building up their own digital lending front end, and we believe that this is something that will work and will continue to work also for others, probably. I think the one thing we do see, though, is that most of the banks in Germany currently have their hands full with other things, and it's probably not on the top of their agenda to build a digital front end for their SME clients, whereas they see 98% of the market still working the way it used to. So it's probably not high up on their agenda, even though, if I was them, it probably should be. But it's not. And I think you mentioned from competition from outside, there is a platform from France that has started or has announced that they will start in Germany as well. So we see others coming in as we speak. But I think that said, the market's huge. There's lots of space for a lot of people. And I think good and healthy competition by professional players is not something we fear at all. I think it's the market needs to develop, and the more people are working on the market development, I think it benefits everybody. I think we're trying to conserve that spirit. I think you need to, or we try to remain agile, to remain nimble, as you said. I think there's, as in most startups and most businesses, there's really no reason small companies should exist. Right? The only reason they exist is because the big ones, the incumbents, are leaving things untended to. Or, banks have brand, they have capital, they have clients. Right? They really shouldn't be anyone working with us, but they are. And why are they? Because as I said, we're faster, we're digital. I think this is the advantage that the small companies have, and being nimble and being agile is something that we try to conserve as long as possible.
I want to ask one more question about the business. Oftentimes hearing from the founder the answer to this question really helps to frame the business. Are you a finance company or are you a technology company?
That's a very good question, and this is actually a question we continue and keep asking ourselves as well. I think the DNA of the people who started this company, started Creditshelf, is finance. But we started consciously going into this business saying there needs to be a technology solution for what the problem is, meaning banks are too slow, it takes too long, the customer experience is horrible. There has to be a technology solution to this. And I think as we grow and as we move along, we become more and more of a technology company. So we started as a fin, now we're probably a fintech, and we might end up being tech somewhere down the road. But technology is in our business is not, you don't need technology for the sake of technology. It needs to serve a client purpose. And the first client you can serve manually, right? And I think you and we did this, and one should do this because you're still learning, how the market works. You don't need technology on day one, but you need to have a business, a solution for a client. And as you grow and scale, you need more technology, because then of cost play a role, and you try to build a business so that it becomes scalable. And once you move more to the tech side, I think that the challenge becomes to not lose the fin side too much, because the business is still on the fin side.
I want to switch gears a little bit. Mm-hmm. Maybe you could take it a few steps back and kind of tell us your entrepreneurial journey and where you come from to how you got to where you are today.
Okay, sure. So my first job was actually at university. So I was a research assistant at university, writing a PhD on pricing of credit risky assets. So my journey started on the risk and mathematical side of risk pricing. I then decided that I would not stay at university, and I moved to London, where I worked for Goldman Sachs for 6 years, also in risk management, so credit risk management and rating advisory. Then I moved to Zurich, to UBS, where I also worked another 5 years, first on the risk side, and then I moved to the corporate institutional client side, which is basically the anything connected with corporate clients, lending, FX, trade finance. That was also the time when I decided I would go back to school. So I joined the WHU Kellogg-WHU MBA program. It was KW16. I think it was 2013. I'm not exactly sure what year exactly. And the reason I went back to school, because I felt that after 10 years plus in banking, my vision was so narrow that I didn't see a lot of what was happening outside anymore. I think, to put it into perspective, I moved to London in 2005. That was still the heydays. Everything was great. Then 2 years later, we woke up in the middle of the largest financial crisis since the 1930s, and that was an incredible experience. Looking back, it wasn't so much fun while we were there, but it was obviously, looking back, as the educational program of a lifetime to see all this from the inside. And I was in the risk management of a large American investment bank, so kind of in the eye of the storm. And then when I moved to Switzerland, I felt that the crisis was kind of abating a little bit. Draghi had given his whatever it takes speech, and it looked a little bit like people were wiping the sweat pearls of their foreheads and saying, okay, great, this is done. Let's go back to the old days, and we'll continue to do our business as we have for the last 3 or 4 decades. And that clearly wasn't the way I was looking at the world. I had this distinct feeling that banking was going to change fundamentally, but I didn't know how. But I decided I needed to go back and look at this a little more from a distance and get more of an outside-in view, and to see basically what other people were thinking about and how they were looking at things. And I chose the WHU Kellogg program for a distinct reason, which was I didn't want to go back and do another finance MBA. Right? I clearly had enough finance education, but what I was missing was entrepreneurial education. Even though I had an interest in this, and I actually in my first degree I did spend a year in Toronto in Schulich School, which is also a partner university of WHU, and I did a part of the MBA program there and took entrepreneurial classes, but never did work as an entrepreneur after that for an extended amount of time. So I felt that I needed to go back and get an outside-in view. And I remember going in, I was like, okay, this has option value, in finance speak, meaning, if nothing happens, I won't get any damage from getting more education, and this might even help my career. But it also provides an opportunity to see if there's something along the way that provides an opportunity to do something myself, because that's been something I've been wanting to do for basically all my life. I went to business school, in my early 20s, thinking I would learn how to, start a business, which of course you don't. But this thought had been there for a while, so I used it as a catalyst, and eventually I came across very smart people who helped me develop the idea, and then everything went from there.
Talk a little bit about your transition going from a multinational global banking environment into entrepreneurship. And obviously there's a cultural shift, but also kind of speaking a little bit to the process.
It was a transition, and obviously I didn't set this up alone, so I had 2 founding partners. It was a transition. I mean, we spent probably 2 years before we made the move, analyzing the market. That was during my EMBA time. We kind of did extensive research on all kinds of things, but there is the point in time where you have to say, are we doing it or not, right? And so we found a good way of doing it, in the sense that we had a third founder who was already helping us setting the scene. We started fundraising, and as soon as we had a relatively good idea that this is actually something that is financeable or fundable, we made the move. But it was still, someone asked me a few weeks ago, is it diving into cold water? And I told him, look, it's not that. You're kind of up there 3 meters in the air, taking a plunge, and you don't even know if there's water in the pool. So that was more the feeling. And I think, but to be fair, founding a company, you can try to rationalize it, but it's not a rational decision. Right? I think from a statistical basis, the probability of succeeding on day one is very low. So you have to have, an inner motivation to try to do it, because one, you really believe in the opportunity. Two, I think you really want to do it because it's something you've always wanted to do, and then you need a lot of luck.
Can you talk a little bit about the process of idea to market? I think you mentioned you capitalized, did some early stage capitalization. So were you bootstrapped for any period of time? Did you take early investors? What was that early process like?
Yeah. So I think the very first stage of this was we tried to pitch this idea to our my co-founder and I work for the same bank. So we pitched this idea to our employer and said, look, this could be a good idea. We believe that SME lending will be digital in the future. Well, why don't you give us a little bit of money and some freedom, and we'll try to do it. And we didn't get very far, which is I think was the expected, but it's also the usual outcome when you have disruptive ideas in big organizations. So we decided the idea was good enough and we wanted to do this. So we started to try to see if we could do it ourselves. The beginning, bootstrapped, yes, we put our own money in. I think the first capital always have to come from the founders, and we were lucky enough to have some reserves from previous employment histories that we could fund the business for the first year. And then, as I said, as we received our first external funding, we quit our jobs and moved on.
Did you raise that external funding through some business angels? Did you go straight a VC play, or were you pretty traditional in that approach? How did you? Do you mind sharing a little bit of that?
Yeah, no. So it was not a traditional VC. We were very lucky to meet our we have a major shareholder today who was also our first investor in the business back in the day, and it was a relatively young organization fund on the other side as well. So we were both kind of starting out as businesses, and we had a very good understanding and of the concept of what we were trying to do, and a very trusting relationship. So we decided to both be a little bit of our first investment. So we were one of the first investments they made. They were obviously the first investor in us, and from there on we grew together.
It's always great when you can be the early investment in a fund. The earlier you are in the lifespan of that fund, the more runway you get in order to get to growth. So it sounds like if your investors are still part of the organization, you were pretty values aligned. Did they also come from the financial services industry? Was that what made the marriage?
Yeah, the principal of this fund has a history in financial services and other things, but he very well understands the ins and outs of banking, and we had a shared frustration with some of the ways that financing works in traditional banks and traditional processes. So this was the basis for our, I would say, very good understanding at the beginning that this is actually a really good opportunity to digitalize this process and to make it much more convenient and much faster.
I want to jump ahead a little bit because something that's interesting about Creditshelf, to me at least, was you got to a phase where you were ready for growth capital. And instead of going large Series A, Series B to really expand your business, you took the approach of going IPO. Now, if I read correctly, correct me if I'm wrong, it was about 5 years after founding that you went IPO.
4 years.
4 years. Well, you just don't hear that story very often. Although I'm sure you answered this question more times than you care to. Can you share a little bit about your strategic approach in doing that rather than taking institutional capital internally?
Yeah. Sure. This question many times, and not the last on the roadshow, of course, where people wanted to understand why we were doing it. There was three main reasons why we did it. I mean, one, capital, but you rightly said we could have probably raised capital elsewhere, but there is still probably some sort of shortage of growth capital in Germany, but that was I'm sure we could have raised it in other ways. But 2 and 3 to me are more important. One is credibility, right? Because we as a multi-sided marketplace business are very dependent on trust that we get from at least the borrower side, because you could argue, well, they take your money, why do they need to trust you? It's absolutely not true. The decent credit borrowers, they want to know who they're working with, right? They won't just take money from anyone because they want to build a relationship. They want to be sure that you're still there next year. It's very important. The German Mittelstand has these companies have been around decades, right? They will not just work with anyone who they don't trust. The same is true on the investor side. Investors who are buying these loans, they're not just looking through to see who they're funding. Of course, they analyze who the borrowers are, but they also need to trust the organization that makes the link. So for us, it's very important to signal and make sure that they understand that we are really in this, one, for the long term, but also we take governance really seriously. We are very serious about, all the things that you as an institutional investor will need to clarify when you do your due diligence, right? And obviously it helps to go, if you will, the painful route to say we go public, meaning, and we're not only going public, we went to the prime standard, so we have quarterly IFRS reporting, governance requirements, all the things that all large companies have as well. On the one hand, it's painful, but on the other hand, it builds the organization on a much stronger, if you will, basis. Right now, it took some time to get these processes running, but what we found is that the organization is much stronger now as a result. We've developed, as we had to implement all these processes, we've also developed a lot. And it makes a big difference to our institutional investors who will now, basically tick the box and say, okay, they're transparent, they're adhering to governance standards. I get quarterly reporting in a decent quality, and it's I don't have to worry about all of this, which could be an issue with a private company. Doesn't have to be, but could be. And the last point is recruiting, and we found it makes a big difference, and that was our hypothesis going in, but we found it's true to make a big difference by attracting talented people, because you are a public company. It makes it much easier for people that we recruit from outside of Germany to do their due diligence on who they're talking to. But it also makes a difference for people who join the organization and say, this gives me a perspective to be early, if you will, in the life cycle of a public company, and who knows where we'll go, but it makes we found that it makes a big difference in recruiting.
I'm interested in the recruitment side, because I do understand startups operate a little differently in Germany than they do in the US. It's almost impossible to hire talent at a startup in the US without having a pretty significant option pool. Most VC funds will be 12 to 15% are allocated for options, so it's significant. And that's one of the carrots that you use to recruit. And as a result of that, you get a very different type of team. They tend to be risk tolerant. They tend to be, eye on the prize, looking at the finish line. I think once you IPO, you become a public company, you may have a little more backing and credibility, but do you see that the profile of your talent changes at all when you change that structure of your organization?
No, I don't think so. And I think one of the things we realized as we went through the IPO process, before and after, is that my personal view, and I think it was our learning, we also had an option program. People have a different concept, or how would I say this? The perceived value of an option on the employee side is not, the economic value that you as a company have to provide. Right? When you go through the process of valuing your option program, you say, okay, this is what I have to reserve for my option program, and you ask the people, so what do you perceive the value of your options to be? It's a big difference, right? So, or saying it another way, is a very inefficient way of paying people. And now that we are a public company, we still use equity to pay people, but we provide it in straight shares. So basically, it's not even an option program anymore. It's a share-based compensation program, which we believe aligns interests, makes people think about the share price and the future of the company. But we moved away from having a leveraged, if you will, equity program, which an option program always is when you have a reserve price, to as a straight share program. And the beauty of being listed is that it's not just theoretical; it's real, right? And you have a vesting still, but you know that you will be able to sell the shares once they're vested. So it's not a theoretical exit, somewhere in the future at a multiple that you can't, comprehend as a human being in the back of your mind. So we find that equity-based compensation based on shares is much more efficient than, option-based compensation in a private setting.
I want to bring it back to you again real quick because going through an IPO, you mentioned earlier that you're trying to maintain the culture and the values of a startup, but obviously with the reporting and the regulatory environments and the greater transparency of being a public company, that you're probably moving a little bit away from being what most people would consider to be a startup. Can you talk a little bit about how you as a leader and a founder, how your work life changed when you made that transition?
It's clearly a change. And I think the most obvious is that I spend a lot more time with investors now than I used to. In the private setting, we had a handful of private investors who I would speak to once in a while. They would call me, I would call them. It's not obviously the same anymore now. We have a quarterly reporting schedule. We do roadshows. We do speak a lot to investors. That's changed. I think what's also changed is the thinking a little bit, and in the sense that you mentioned regulation. Of course, as a public company, we have reporting requirements that go beyond quarterly reporting. So if we do something substantial, or we even think about something substantial, we have to consider: is this ad hoc? Do we need to report this ad hoc? Is this something that the markets need to know about now? I think that is something that you need to be aware about, and you need to, I think, make sure that it doesn't stop you from being creative and from thinking about things. Right? I think it's clearly one of my jobs now to manage this process in the sense, what do I need to communicate to whom? It's not always easy, and I think we found this ourselves as we made this transition that, and as you cannot speak about everything all the time anymore to all or any of the people that you have in your organization, it becomes a challenge of communicating better. This is something that is still, something that we are working on to find the right balance between, being communicating in a timely manner, making sure everybody knows what they need to know, but at the same time not, creating too much confusion or. That's become more difficult, I think, very clearly.
You mentioned earlier when we were talking about employee options, the difference between perceived value and tangible value. And I think that same narrative can be applied to the business as a whole. An advantage and a disadvantage of an early stage startup is there's a perceived value that may not be congruent with the more tangible value. It's August 2019. There's some perhaps writing on the wall of people talking about recession in the future. Do you feel now you're more tied to the fluctuations of the global economy or even the regional economy? And how do you feel that affects your future potential for growth or capitalization or things along those lines?
I think our business model has always had, some ties to the economic cycle. Even though we're not taking the loans on our own balance sheet per se, there's still, first question investors will ask you is, does this work through a recession or through a credit cycle? We strongly believe that this business, as we're building it, needs to be able to perform through a recession, through a cycle, right? And actually, nobody wants to have a recession, but it's maybe also an opportunity to take this off the table for once and for all, to say, look, we've gone through it, everything was fine, you don't need to worry about it. But I agree with you that as we go into maybe a not so clear economic path over the next months, and who knows, right? Maybe you will listen to this next year and there hasn't been a recession at all, who knows? But it's clearly something that we're conscious about, more on the origination side, as we say, look, what does it mean for the borrowers that we're serving? What does it mean? Because we're providing these investment opportunities for the investors, and we obviously want them to have a good performance through the cycle. I think one of the first things after we went public, one of our larger investors told me, it's like, look, there's one mistake you shouldn't make, which is to basically have day-to-day market information influence your running of the business or your decision making, right? And I think that's probably one of the more difficult things that I needed to learn as we went through this process. Yes, I look at the stock price every day, but it should never inform the decision that I make on the operating business, and it doesn't.
Right. Well, whether there's a recession or not, I can't think of anyone who I'd rather have, captaining the ship than someone that literally worked in the heart of the subprime lending crisis. So I can't imagine you're going to see any worse than you had to stomach 10 years ago, right?
Yeah, that's true. Comparing back to the 2008, 2009, times, this is clearly not anywhere near, as bad as it was back then.
I want to ask you to think forward into the future. Can you tell me a little, what do you see as the future for the SME sector in Germany?
What we see from clients that knock on our doors and that we're serving, they tend to have very good niche businesses in some of very interesting areas of the economy, right? And a lot of them are international. A lot of them are very innovative on their own product side. I think what we're trying to bring to them is innovation on the liability side of the balance sheet, because if you ask 100 entrepreneurs, how is it going, what are you doing, I will take any bet that 99.x% will talk about the next product, the next market, and probably none of them will say, I raised great funding from the bank last week and I paid X.X%, and that was actually 20 basis points less than I paid a year ago. It's not how they think. But it's still a huge, in our mind, a huge opportunity for value creation, for funding properly, and then moving on to do the things that you do best, which is on the other side of your balance sheet. Why is that relevant to the question you asked? I think they need to be able to move on in the business that they do, and obviously there are challenges as well. The digitalization and shifting rules of the game, if you will, in automotive, for example, will have an effect on German companies, and it will trickle down to SME as well, because this is you have the large OEMs, and then you have large suppliers, but then behind that you have a lot of Mittelstands companies that are suppliers to either OEMs directly or the suppliers. But what we find there is that they're very flexible. They're pretty nimble in thinking ahead. They are a lot of times we fund programs or we fund projects that they are working on that are really innovative, right? For example, weight saving in components for car manufacturing, or electric mobility, or other things that they're already working on, that they were quick on their feet to find a way to see what the future will be, and to be able to position themselves. So yes, we see a few that have relatively old management, but a lot of them are also next generation already, or started up from people who are our age.
So you have a pretty stable market base with potential growth, especially as the younger generations come in that are more comfortable operating and transacting in the online space. Maybe you can just tell me a little bit about the future of Creditshelf. Where are you now? Where are you going? Do you have any big milestones you're seeking? Where do you see yourself a few years down the road and beyond?
So one of the downsides of being public is obviously that I can't tell you everything, but what I can share is what we have also made public anyway. So we have a midterm goal of providing 500 million euros of credit per year to the German economy. We're not there yet, but we're growing towards that. We are on a roughly, I would say, 2x trajectory for the moment, where we double volumes or have doubled volumes in the past year over year, more or less. As I mentioned before, the market is huge. It's 300 billion, 2% digitally penetrated. We believe the penetration rates could well be 10% and more going forward. And that's only the market that's been served. There's probably another 100 billion out there that's not been served, and if there's also data for that. That we've looked at. Basically, if you compare the GDP growth rate over the last 10, 12 years compared to the growth rate of lending volumes outstanding, there's a delta that accounts for another 100 billion that should have been lent but haven't been lent. So we believe there's a large opportunity to provide this to fill this credit gap and to provide a service in the digitalizing world to people who are looking for digital solutions. So a long way of saying we want to continue to grow. We want to continue to improve our processes, make it more convenient for users on both sides, meaning faster and easier for people to apply for credit, easier and better for institutional investors to invest in credit. If you look at surveys that are being done in this and other spaces, in lending spaces, the number one pain point that all of the SME companies mention when they get asked, how do you think about lending or borrowing? It's the amount of paperwork that's required, the pain of going through the process, and the time it takes to do it. Right. So these are the things that we're trying to address. And what we find is people who think about it for a moment, and maybe it's a lot of the next generation clearly is not willing to put up with a lot of what has been the norm in the past. Right, you go to a bank, you wait 4 to 6 weeks for an appointment. It takes 3 months before you get your loan. They fund themselves privately on their mobile phone in 2 minutes, right? And it takes 6 months to fund their business. It's clearly something they're not willing to accept, and we will continue to work to being positioned to fulfill this requirement.
All right, Tim, I wanna just do 2 rapid fire,
Please.
very personal questions to get into you. I ask everyone I speak with these same questions. At least 75% of them roll their eyes and hate answering them, so I'm going to prepare you right now. But
Okay.
I've always found that you can learn so much about a person by what they read. What book is on your bedside table right now? Or audiobook, or what have you read recently that you'd like to share?
Yeah, actually, I still read books with paper and all. And there's actually 2 right now on my desk. It's one is Good to Great. You probably know it. It's been on my reading list for a long time, and I finally got around starting it. Very good. I've read half of it, and I can only recommend. It's the first half is great. I'm sure the second half will be as good. The second one is actually I forgot who wrote it, but it's a report on the Chernobyl accident, right? Basically, and the reason I bought it is. I think you learn as much from success stories and probably more from disasters, right? And so to see what happened to an organization that was, outside in, probably well run, because it was a live nuclear power plant, right? It's still up in flames, and it's a very interesting story.
All right, one more question for you. In a similar vein, what's on your playlist?
Actually, to be very honest, I used to have a subscription to. What's the name? Spotify, but I haven't used it in a long time.
Well, you're going to have to download it, because that's where you're going to listen to this podcast. Awesome. Well, Tim, thank you so much for taking the time out of your incredibly busy schedule and inviting me here to your offices. I really enjoyed the conversation, and I look forward to sharing your story with aspiring entrepreneurs at your alma mater at WHU.
Thank you very much for the time. It was great to be here.
Thanks for having me.
Well, folks, that was Tim Thabe, co-founder and CEO of Creditshelf, Germany's first publicly traded fintech startup, and a unique business that links Germany's small and medium-sized businesses to investors that provide the capital they need. Coming soon in episode 6, we'll speak with Philipp von Hammerstein, former founding GM of Le Wagon Coding Bootcamp Berlin, and current head of corporate education at Code University of Applied Sciences. We'll be discussing software development, teaching people how to code, non-technical entrepreneurs, and productivity tips. It'll be a fun conversation with a charismatic entrepreneur. Hope you'll like it. Bis nächstes Mal.